If you're over 68 and think consistent monthly income is out of reach, listen closely, because David Tepper would tell you this is not the end of your financial story. It's the most strategic chapter of it. At 68 plus, time becomes your most valuable asset, not speed, not hype. David Tepper's mindset proves that wealth isn't about age, it's about positioning. In this video, we'll break down how Tepper would aim to generate $5,000 every month, sustainably and intelligently, without gambling your future, only strengthening it. David Tepper would begin with one unshakable principle: protect the capital at all costs. At an advanced stage of life, money is no longer just a tool for growth, it is security, freedom, and peace of mind. Tepper understands that once capital is damaged, the ability to generate reliable income collapses with it. That's why he would never approach investing with desperation or impatience. Instead of chasing fast gains, he would focus on preserving the foundation that took a lifetime to build, because only stable capital can support income that lasts for decades. He believes explosive growth is overrated when stability is the real objective. Rapid returns often come with hidden risks, emotional stress, and irreversible losses. Tepper would argue that no monthly income is worth sleepless nights or constant anxiety. At this stage, wealth should reduce stress, not create it. Capital protection means accepting that slower, steadier returns are not a weakness, they are a strategic advantage. When money survives market crashes, interest rate shifts, and economic cycles, it keeps working long after risky money disappears. Preserving capital also means understanding downside before upside. Tepper is famous for obsessively analyzing what could go wrong before committing to any opportunity. For someone over 68, this mindset becomes even more critical. Every investment must answer one question first: how much can I lose if I'm wrong? If the downside threatens lifestyle, healthcare, or independence, it's automatically rejected. Tepper would never risk essential capital for optional rewards. Income should come from strength, not hope. Another key aspect of capital protection is liquidity. Tepper values flexibility, especially during uncertainty. Money that is completely locked away limits your ability to adapt. He would ensure a portion of capital remains accessible, allowing income strategies to adjust as markets change. This flexibility reduces forced selling during downturns, which is one of the fastest ways to destroy long-term income potential. Protected capital gives you options, and options create control. Diversification also plays a central role in preservation. Tepper would never rely on a single source of income or one type of asset. Capital is shielded by spreading exposure across industries, instruments, and timelines. This approach doesn't eliminate risk, it contains it. When one area struggles, another supports the overall income stream. Over time, this balance allows capital to survive shocks that wipe out concentrated portfolios. Most importantly, capital protection is psychological discipline. Tepper knows that emotional decisions are the biggest threat to wealth, especially later in life. Fear during market drops and greed during rallies both tempt investors to abandon their strategy. By prioritizing preservation, decisions become calmer, clearer, and more rational. The focus shifts from how much can I make to how long can this money support me. That shift changes everything. In Tepper's world, protected capital is power. It allows income to flow consistently, confidently, and without fear. Growth still happens, but it's a byproduct, not the mission. When capital is preserved, income becomes predictable, and when income is predictable, life becomes free. David Tepper would place his attention squarely on assets that produce cash flow, because real wealth is not about price movement, it's about money hitting your account consistently. Speculation depends on prediction, timing, and emotion, all of which become liabilities over time. Cash flowing assets, on the other hand, are built on function. They work regardless of market noise. Tepper understands that dependable income removes pressure, and when pressure disappears, better decisions follow. Dividend-paying stocks would be a core focus because they represent ownership in businesses that generate actual profits. Tepper would not chase companies promising future breakthroughs with no earnings. He would prefer firms with strong balance sheets, steady demand, and a history of rewarding shareholders. Dividends turn volatility into opportunity. When prices fluctuate, income continues to arrive, reinforcing confidence and patience. That steady stream reduces the temptation to sell during market dips, which protects both capital and long-term income. Income-focused funds would also play an important role. These vehicles pool diversified assets designed specifically to generate yield. Tepper appreciates efficiency, and income funds simplify the process. Instead of managing dozens of individual positions, Income funds provide structured exposure with professional oversight. This reduces decision fatigue, which becomes more valuable with time. The goal isn't to constantly react. It's to let a well-designed system do the heavy lifting while income arrives automatically. Yield-focused investments align perfectly with Tepper's philosophy of control. When an asset pays you regularly, you're not dependent on someone else buying it at a higher price. You are paid for owning it. This shifts the mindset from guessing market direction to collecting value. Yield creates independence from daily headlines, economic fear, and emotional swings. Tepper knows that peace of mind is a form of wealth, and consistent income delivers exactly that. Another advantage of cash-flowing assets is compounding without effort. Tepper would likely reinvest early income to strengthen future cash flow. Each payment becomes a building block, increasing monthly income without adding risk. Over time, this snowball effect transforms stability into strength. Income grows not because of speculation, but because the system feeds itself. That is how money works while you sleep, quietly, predictably, and powerfully. Cash flow also improves flexibility. When income arrives regularly, unexpected expenses don't force liquidation of assets. Tepper understands that forced selling is one of the greatest enemies of wealth. Cash-flowing investments act as a financial buffer, absorbing shocks without damage. This is especially critical later in life. When preserving lifestyle matters more than maximizing returns, income provides resilience, and resilience protects dignity. Most importantly, Tepper avoids constant decision-making because he respects mental capital. Every decision carries the risk of error. By choosing assets designed to pay consistently, he minimizes the need for action. The best strategy is often the one that requires the least interference. Speculation demands attention, timing, and emotional control. Cash flow demands patience and discipline. Tepper would choose discipline every time. In the end, cash-flowing assets turn investing into ownership, not gambling. They replace stress with structure and replace uncertainty with reliability. For Tepper, this isn't just smart investing. It's the foundation of financial freedom that lasts. David Tepper approaches investing with the mindset of an owner, not a trader, and this distinction shapes every decision he makes. To him, owning a piece of a business is about understanding its fundamentals, its ability to generate real profits, and its potential to provide consistent returns over time. He doesn't chase hype trends or flashy stories promising exponential growth without substance. Instead, he focuses on enterprises that have proven themselves capable of delivering actual earnings. Tepper believes that when you treat your investments like a part of your own company, your perspective changes from what will the price do tomorrow to how can this business generate value sustainably. This shift in mindset is crucial, especially for someone looking to secure steady monthly income at an advanced age. He would target businesses with clear revenue streams and predictable cash flow. For Tepper, the ability of a company to pay dividends or distribute profits regularly is far more important than its short-term stock movement. If a business can reliably pay investors monthly or quarterly, it's a signal that it has operational strength and stability. These payments are not just numbers, they represent the actual fruits of ownership. When money flows consistently from a business, it transforms investments into a source of security and independence, which is the ultimate goal for those seeking income longevity. Tepper's owner mindset also means doing deep due diligence. He would analyze balance sheets, income statements, and cash flow reports meticulously to ensure the company is not only profitable today, but capable of sustaining profits into the future. He would assess management quality, competitive advantages, and market positioning. Ownership is about responsibility, and Tepper approaches it with the seriousness it deserves. Unlike speculative investing, which relies on guesses about price direction or market sentiment, this approach relies on tangible, measurable performance. He invests in what he can understand, what he can trust, and what has a history of creating value. Another crucial aspect of thinking like an owner is patience. Tepper would not expect immediate windfalls. Instead, he would focus on the long-term health and profitability of the business. Ownership is about commitment and endurance. He would hold on to these investments through market cycles, understanding that volatility does not change the intrinsic value of a strong business. Consistent, reliable income comes from this kind of disciplined, patient ownership. Additionally, thinking like an owner changes the way you react to challenges. When a business encounters temporary setbacks, an owner sees opportunity instead of panic. Tepper would likely analyze whether the core operations remain strong, whether cash flow continues, and whether the management team is capable of navigating difficulties. This perspective allows him to act decisively when others hesitate, often positioning him to benefit from situations that seem risky to speculators. Ultimately, Tepper's owner mindset transforms investing from a passive gamble into an active partnership with productive enterprises. He seeks businesses that generate real profits, provide tangible cash flow, and reward ownership with regular distributions. By focusing on true value rather than stories, he ensures that income is sustainable, predictable, and powerful, turning investment into a reliable foundation for life. This disciplined approach is how he would generate steady monthly income, creating security and financial confidence that lasts indefinitely. David Tepper approaches risk with a mindset that is both fearless and disciplined, understanding that risk is not something to be avoided, but something to be managed intelligently. For Tepper, fear of risk leads to stagnation, missed opportunities, and ultimately underperformance. He knows that in investing, every decision carries inherent uncertainty, but the difference between success and failure lies in how that uncertainty is quantified, controlled, and distributed. Risk, in his philosophy, is a tool to be understood rather than an obstacle to be feared, and managing it effectively is the key to long-term financial stability, especially for someone seeking consistent monthly income in later life. Tepper begins by meticulously measuring risk before committing capital. He examines the potential downsides of each investment, evaluates worst-case scenarios, and determines whether the potential reward justifies the exposure. This methodical assessment prevents impulsive decisions driven by emotion or short-term market trends. For him, understanding the probability and impact of risk allows him to make bold moves with confidence rather than reckless gambles. He treats every dollar as a soldier in his portfolio army, ensuring each one is strategically positioned to protect and grow wealth without jeopardizing long-term security. Diversification is central to Tepper's risk management strategy. He spreads investments across multiple income streams, asset classes, and industries, understanding that no single opportunity is infallible. By doing so, he ensures that one underperforming asset will not derail the entire income plan. Dividend-paying stocks, rental properties, bonds, and income funds can work together to create a safety net. When one sector struggles, others can compensate, keeping cash flow steady. This multi-layered approach allows for resilience in unpredictable markets, giving Tepper the ability to generate consistent monthly income without fear of catastrophic loss. Another aspect of his approach is maintaining balance between risk and reward. Tepper doesn't eliminate risk entirely, because doing so often limits returns to the point where income cannot grow meaningfully. Instead, he accepts calculated risks that have a favorable risk-to-reward ratio. This ensures that the portfolio is always positioned to benefit from opportunities while remaining insulated from the worst possible outcomes. Risk becomes a partner in wealth creation rather than a threat to be avoided. Psychology also plays a crucial role in Tepper's approach. He understands that fear and greed are the greatest enemies of financial discipline. By managing risk rather than avoiding it, he removes emotion from decision-making. The knowledge that one mistake cannot destroy his lifestyle instills confidence, allowing him to act decisively when others hesitate. This mindset is essential for anyone seeking sustainable income later in life. Ultimately, Tepper demonstrates that risk, when understood, measured, and distributed, becomes a source of power rather than a source of fear. Diversification, careful analysis, and strategic allocation ensure that income streams remain uninterrupted even in volatile markets. By managing risk intelligently, he protects his lifestyle, secures financial freedom, and generates income that can last indefinitely. In Tepper's world, risk is not an enemy. It is the pathway to control, confidence, and lasting wealth. David Tepper would view market fear not as a threat, but as the greatest opportunity for long-term income and wealth creation. While most investors react to panic with stress and impulsive decisions, Tepper sees the exact opposite. When fear grips the market, asset prices drop to levels far below their true value, and yields on cash flow and investments rise. This is a fundamental principle in his investment philosophy. He doesn't follow the crowd, he acts contrary to it, understanding that panic is temporary, but the advantages it creates can last for decades. For someone over 68 seeking a sustainable $5,000 in monthly income, learning to exploit market fear can turn volatility into a reliable source of wealth. When markets crash or decline sharply, most investors focus on losses and immediate uncertainty. They sell their holdings, often locking in losses, and withdraw from opportunities, thinking they are protecting themselves. Tepper, however, recognizes that this behavior creates a vacuum of undervalued assets. Dividend-paying stocks, high-quality bonds, and income-generating real estate often become available at significantly reduced prices during panic periods. By buying when others are selling, he acquires these assets at a discount while simultaneously increasing potential cash flow because yields rise inversely with price. In other words, the very panic that terrifies the market actually improves the income potential of each investment. Tepper's ability to exploit fear is grounded in preparation and patience. He does not act recklessly during a downturn. He waits for the right moment when fear has driven prices low enough to offer both security and opportunity. By being patient, he avoids the emotional traps that cause most investors to overact. He focuses on businesses or assets that have strong fundamentals, capable management, and resilient income streams. When these assets are temporarily undervalued due to panic, the long-term potential becomes much more attractive. Another critical aspect is that exploiting market fear is not about chasing short-term gains, it's about locking in long-term income. When an investor purchases a high-yield stock or bond during a panic, the income generated from that investment immediately increases relative to the capital invested. Over time, this income compounds, and because the assets were acquired at low prices, the yield remains strong even as prices stabilize. This strategy transforms fear into a tool for securing predictable monthly income that can continue for decades. Tepper also understands that fear is cyclical. Markets go through phases of euphoria and panic, and by preparing for downturns, he ensures that his capital is ready to be deployed when opportunities arise. This is particularly important for someone relying on income later in life. Timing and readiness are everything. By keeping liquidity available and understanding which assets provide real cash flow, he is able to strike decisively during fearful periods when others hesitate. Ultimately, exploiting market fear is a combination of courage, preparation, and discipline. Tepper doesn't gamble, he calculates. He understands that panic is temporary, but the advantages it creates can lock in long-term income that is stable, predictable, and resilient. By acting when others panic, he converts volatility into opportunity, ensuring that even in uncertain markets, consistent monthly income can be secured for years to come. For Tepper, fear is not something to avoid. It is the gateway to control, security, and financial freedom. David Tepper would insist that consistency beats excitement every single time, especially when the goal is to generate reliable monthly income later in life. Many investors fall into the trap of chasing thrilling opportunities, hoping for instant returns, only to discover that short-term excitement rarely translates into long-term stability. Tepper understands that building $5,000 per month is not a sprint, it's a carefully structured marathon. The key is disciplined allocation, strategic patience, and relentless focus on long-term outcomes rather than fleeting market trends or headlines. The first step in achieving consistent income is creating a disciplined allocation strategy. Tepper would not scatter investments randomly or put all capital into a single high-risk opportunity. Instead, he would systematically divide resources across assets that provide steady cash flow. Dividend-paying stocks, high-quality bonds, real estate, and income-focused funds would form the core of his portfolio. Each allocation would be chosen not for the excitement it generates in the moment, but for its ability to produce predictable, repeatable income over time. By following this structured approach, Tepper ensures that income streams accumulate steadily, providing a reliable foundation for monthly withdrawals. Patience is equally critical. Tepper knows that markets do not move in straight lines, and income does not compound overnight. $5,000 per month is the result of years of careful positioning and disciplined reinvestment. The first phase may produce modest returns, but when each income stream is reinvested thoughtfully, the growth becomes exponential over time. This is the principle of compounding applied to cash flow. The key is to resist the urge to chase quick wins or abandon the plan during short-term market turbulence. Patience, in Tepper's philosophy, is not passive waiting. It's active preparation and confidence in a well-designed system. Consistency also means avoiding emotional decisions. Excitement often triggers impulsive moves, buying at the peak, selling during a dip, or overexposing capital to high-risk ventures. Tepper would argue that emotional reactions are the enemy of sustainable income. By adhering to a disciplined strategy and consistently contributing to income-generating assets, investors can avoid these pitfalls. Discipline transforms investing from a roller coaster of highs and lows into a steady march toward financial security. Another dimension of consistency is monitoring and adjusting allocations without abandoning the core strategy. Tepper would track performance, rebalance portfolios, and respond to changes in markets or personal needs, but always within a framework designed to maintain stability. This controlled adaptability ensures that income streams remain resilient, even when external conditions fluctuate. The excitement of chasing trends is replaced with the satisfaction of measured progress and the confidence of predictable results. Ultimately, Tepper's principle is clear. Sustainable monthly income is built through consistency, not excitement. 5,000 per month is not a magical number achieved through luck. It is the product of disciplined allocation, patient reinvestment, and unwavering focus on long-term results. By prioritizing steady growth and reliable cash flow over the thrill of speculation, investors can secure income that endures, bringing freedom, security, and peace of mind for years to come. Consistency is the engine, patience is the fuel, and disciplined action is the path to lasting financial independence. David Tepper would view the early income generated from investments as the seed for something much larger, understanding that reinvesting it is the key to creating a self-sustaining financial engine. For him, the initial phase of cash flow is not the final goal. It is the foundation upon which greater wealth, predictable monthly income are built. By allowing early income to compound, Tepper transforms modest earnings into a powerful, ever-growing source of funds that eventually require minimal additional effort to maintain. This principle is especially crucial for someone over 68, aiming to generate 5,000 per month without depleting their capital. The strategy begins with disciplined reinvestment. Tepper would not treat early income as discretionary spending. Instead, he would redirect it into the same high-quality, cash-flowing assets that generated it in the first place. Each dividend payment, interest installment, or rental income is reinvested strategically, buying more units of productive assets or expanding existing holdings. By doing so, the initial capital grows exponentially because the reinvested income starts generating its own income. Over time, this compounding effect accelerates, turning a modest initial investment into a significant monthly cash flow without increasing risk beyond the original plan. Early reinvestment also builds momentum, a concept Tepper relies on heavily. At the start, income may appear small and incremental, and some investors might feel discouraged. However, Tepper understands that these small payments are the building blocks of larger returns. As reinvested income generates additional earnings, the portfolio grows not just linearly, but geometrically. Each cycle of income and reinvestment strengthens the base, creating a feedback loop where money works harder and faster. This momentum eventually leads to a phase where the portfolio can generate substantial monthly income on autopilot, reducing reliance on further active contributions or high-risk speculation. Another critical aspect of this approach is the psychological benefit of compounding early income. Seeing reinvested income grow steadily reinforces discipline and patience. Tepper would argue that confidence in the compounding process allows investors to remain steady during market volatility, resisting the urge to withdraw prematurely or chase short-term excitement. By focusing on long-term accumulation rather than immediate gratification, the income stream gradually transforms from a supplemental resource into a cornerstone of financial independence. Tepper would also emphasize that reinvestment should be strategic and selective. Not every early income dollar should go into the same asset blindly. The reinvestment must maintain diversification, minimize risk, and continue to target high-quality cash flow and opportunities. This ensures that as income grows, it remains resilient and predictable, capable of sustaining 5,000 per month even in fluctuating markets. Ultimately, reinvesting early income is about creating self-sustaining momentum. Tepper demonstrates that patience and discipline at the beginning lead to financial autonomy later. The compounding of income transforms effort into efficiency, risk into reward, and initial modest gains into a reliable, long-lasting income stream. By letting the first phase of income compound, the investor moves from dependence on active decisions to the freedom of automated, predictable monthly cash flow, achieving both stability and growth simultaneously. This is how Tepper would secure income that lasts indefinitely. David Tepper understands that simplicity is not a limitation. It is a strategic advantage, especially when the goal is to generate reliable monthly income later in life. He recognizes that complexity often disguises risk, obscures clarity, and increases the likelihood of mistakes. For someone over 68 seeking 5,000 per month, overly complicated systems are more than inconvenient, they are dangerous. Tepper avoids intricate schemes, convoluted strategies, and exotic investments that promise high returns but carry hidden pitfalls. Instead, he focuses on simple, understandable income strategies that anyone can monitor, adjust, and trust over time. The beauty of simplicity lies in control. Tepper would invest in assets that are transparent and whose income mechanics are easy to grasp. Dividend-paying stocks, bonds, real estate, and income funds are all straightforward. They generate cash flow in predictable ways and have performance that can be tracked without relying on speculation or complex models. By keeping things simple, he minimizes the risk of surprises that could erode capital or interrupt income. In his philosophy, if you cannot explain how an investment produces income in a clear, logical way, it is not worth the risk. Simplicity also promotes consistency. Complex strategies often demand constant attention, recalibration, and expertise. They can be mentally exhausting and lead to mistakes, especially in later life when the tolerance for stress and uncertainty may be lower. Tepper avoids this trap by choosing strategies that produce results without requiring constant intervention. The income streams become predictable, allowing him to plan confidently for monthly expenses and long-term goals. This focus on straightforward income sources enables disciplined reinvestment, compounding, and long-term wealth accumulation without the distraction of intricate systems that rarely outperform simple ones in practice. Another advantage of avoiding complexity is risk management. Complicated strategies often have hidden dependencies, opaque fees, or leverage that magnify losses in ways that are hard to predict. Tepper knows that understanding risk is paramount, and simplicity makes it measurable. When every investment is understandable, it is easier to evaluate potential downsides, allocate capital effectively, and adjust when necessary. This clarity protects both capital and peace of mind, which is critical for anyone seeking sustainable monthly income in their later years. Simplicity also encourages focus on what truly matters: income generation. Tepper does not get distracted by chasing the next investment or speculative opportunity. Instead, he identifies high-quality assets that produce consistent cash flow, reinvests income strategically, and lets compounding work its magic. The simplicity of the strategy amplifies results because energy and attention are concentrated on optimizing the essentials rather than chasing complexity. Finally, simple strategies are easier to adapt over time. Life changes, markets evolve, and financial needs shift. Tepper understands that flexibility is easier to maintain when the underlying system is clear and uncomplicated. Simple, understandable income strategies are resilient, scalable, and manageable even as circumstances change. In Tepper's philosophy, simplicity is strength. By avoiding complexity, he ensures that income strategies are not only effective, but also sustainable, predictable, and stress-free. Simple approaches outperform confusing systems because they reduce error, minimize risk, and allow disciplined, long-term execution, especially when building a reliable monthly income in the later stages of life. David Tepper's approach to investing and generating income is defined by one fundamental principle: emotion has no place in decision-making. He understands that fear and greed are the two most destructive forces in financial planning, particularly for someone relying on income rather than growth speculation. When fear dominates, investors sell prematurely, lock in losses, and miss opportunities. When greed dominates, they chase high-risk ventures, over-leverage, or ignore fundamentals. Tepper avoids both by relying strictly on data analysis and objective reasoning. This detachment from emotion is critical for creating predictable, long-term monthly income, especially later in life. At the core of Tepper's philosophy is data-driven decision-making. He examines metrics that reveal the true health of an investment: cash flow, profitability, debt levels, yield, and market valuation. These concrete numbers provide a reliable foundation for decisions, free from the influence of headlines, rumors, or market hype. By focusing on quantifiable evidence rather than sentiment, Tepper ensures that each move supports stability and sustainability. For someone over 68, this approach is invaluable because it protects both principal and the regular income needed for living expenses, healthcare, and lifestyle maintenance. Fear, in particular, can erode income plans quickly. During market downturns, many investors panic and sell assets at depressed prices. Tepper understands that this reaction is almost always counterproductive. Data reveals that quality investments recover over time, and selling in fear turns temporary volatility into permanent loss. By removing emotion from the equation, Tepper can act decisively, buying undervalued income-producing assets when others are retreating. This is exactly how he would position a portfolio to generate $8,000 per month in a sustainable way. by capitalizing on opportunities created by fear rather than succumbing to it. Greed is equally destructive. The temptation to chase the highest yields or the next big thing often leads to riskier investments with hidden dangers. Tepper avoids this trap by setting clear parameters and sticking to them. Investments are chosen for their reliability, not their potential for explosive but unpredictable returns. Data shows that disciplined, moderate yield investments often outperform speculative strategies over the long term, particularly in terms of consistent monthly income. Greed-driven decisions may offer short-term excitement, but they destabilize portfolios and threaten both capital and income security. Clarity is the ultimate safeguard in Tepper's approach. When every decision is guided by objective analysis, risk is measurable, diversification is intentional, and income streams are predictable. Emotional detachment allows him to follow a plan without being swayed by market noise, personal biases, or temporary setbacks. Income becomes a function of strategy, not chance. Finally, removing emotion also reinforces patience. Tepper recognizes that income growth, reinvestment, and compounding take time. By relying on data instead of emotion, he maintains consistency and focus, resisting the urge to react impulsively. Each decision reinforces the long-term plan, turning modest early gains into sustainable monthly income. In Tepper's world, clarity and data replace fear and greed. By removing emotion, he protects both capital and income, ensuring that every decision contributes to stability, growth, and financial freedom. This disciplined, analytical approach is what makes predictable monthly income achievable, even in uncertain markets, and why Tepper strategies are as much about mindset as they are about money. David Tepper approaches wealth with a mindset that transcends short-term goals, understanding that true financial success is measured not by months or years, but by the long-term impact it has on life and legacy. For him, the mindset of an investor is forever. It is not limited to chasing temporary returns or reacting to immediate market fluctuations. Tepper thinks in generations, envisioning how decisions made today will influence financial stability, freedom, and dignity decades in the future. This perspective transforms every investment, every strategy, and every decision into a tool not just for income, but for lifelong security and peace of mind. At the heart of this philosophy is the recognition that money is not merely a number. It is a vehicle for freedom and confidence. While $5,000 in a month might be the immediate goal, Tepper understands that the real objective is much deeper: to create a life where financial worries no longer dictate choices or limit opportunities. By adopting a long-term mindset, he ensures that every step taken today contributes to sustained wealth that can support lifestyle, health, and legacy far into the future. It is not enough to generate income. That income must endure, grow, and remain resilient through life's inevitable uncertainties. Thinking in generations also shapes the way Tepper approaches risk and reward. He doesn't make decisions with the mindset of chasing short-term wins or speculative gains. Instead, he prioritizes strategies that can weather economic cycles, market volatility, and unexpected challenges. Investments are chosen not just for their immediate yield, but for their potential to generate consistent, reliable returns over decades. This requires patience, discipline, and an unwavering focus on fundamentals, ensuring that both capital and income remain secure. By avoiding the temptation to react impulsively, Tepper's approach protects the financial foundation that will benefit not only himself, but potentially future generations. Another aspect of the forever mindset is the emphasis on clarity and control. Tepper invests in opportunities he understands, avoids unnecessary complexity, and focuses on strategies that can be maintained over the long term. This approach reduces stress, prevents mistakes driven by emotion, and allows for confident decision-making. When the goal is lifelong financial dignity, clarity becomes just as important as capital. Each investment is evaluated for its ability to produce sustainable income, maintain stability, and enhance confidence, not just to deliver momentary excitement or headline-grabbing returns. Ultimately, the mindset Tepper advocates is about more than money. It is about life. Financial strategies are designed to provide freedom, independence, and dignity, allowing one to live without fear, compromise, or limitation. By thinking beyond years and focusing on generations, he ensures that income is not just temporary relief, but a permanent foundation of security. $5,000 a month is not the finish line. It is a stepping stone toward a life of peace, confidence, and control over one's destiny. Tepper's approach teaches that wealth is a mindset, not a number. By embracing a long-term perspective, prioritizing sustainability over spectacle, and focusing on clarity and discipline, he creates income strategies that endure. This is how financial freedom is achieved, not just for months or years, but for life and the legacy one leaves behind. Age is not a limitation, it's leverage. Think strategically, act patiently, and let your money work harder than you ever had to. This is how David Tepper would do it, and so can you.